Good morning, it's Jeff Christian from CPM Group. It's 11 a.m. on Friday, the 8th of October. Today I wanted to refocus some of the discussion on the things that matter and really affect gold and silver prices. I'll have a brief market update similar to the one that we gave on Tuesday, and I'll talk a little bit about where we see silver going in the fourth quarter compared to what some other people say. These are two quotes that I like to put into presentations sometimes, especially when I have people who will believe in conspiracy theories and other kinds of things there. You know, Bernard Baruch, every man is right, has a right to his opinion, but no man has a right to be wrong in his facts. And it's amazing, you know, some of the facts that you hear that are just patently wrong. But that's the way of the world. And then Eric Hoffer, who coined the term true believer in the book True Believer, said, you know, that you can't convince a true believer that what he or she believes is wrong based on evidence from the senses, reason, because if you're a believer, changing your beliefs based on evidence or facts or reality is heresy. And I think that's very important to understand. You know, we talk about the markets for CPM Group's research and consulting, which are not necessarily people who are true believers or fanatics or conflict entrepreneurs or conflict addicts, but rather investors who look at the world and say, why isn't it a better place? Why don't governments and regulators and other people do better things and ethical things and intelligent things? Same questions that we have ourselves. And those are the people that we reach out to who really want reality. I did a video with Kitco on Tuesday, and they spent 15 minutes talking about all this nonsense about silver conspiracy theories. And it is, you know, to be polite, which I'm sometimes not, nonsense, utter nonsense. And it's been beaten to death. It's been beaten to death, not this year, but it's been beaten to death for decades. There's a guy who every week posts some comment on our YouTube, why don't you talk about manipulation and all of the fines that various banks, they love to talk about JP Morgan, but it's, you know, Deutsche Bank, Barclays Bank, UBS, a variety of other banks. Why don't you talk about the fines they paid for manipulation and how they manipulate the market? And the answer is, we've beaten that to death. No reasonable person has looked at the evidence and said, okay, yeah, there's a conspiracy. The fines have almost exclusively to the banks been for non-supervision of bros on trading desks who were spoofing the market and going into, you know, manipulation for 1 minute or 5 minutes or something. There's been no grand conspiracy. And we've seen this discussion starting 20, 30 years ago about the grand conspiracy of banks and central banks and governments to suppress the gold and silver prices. And it's nonsense. It doesn't make sense for the governments to want to do that, and it doesn't make sense for the banks to do that. And we've talked that to death, and I don't want to talk about it. Now, I want to focus on the things that determine gold and silver and platinum and copper and oil prices. And that's what I'm going to try to do today once I get behind this. And for those guys who want to put that in there, well, yeah, some people say that they're getting paid $10 or $10 in chopped meat to harass me. That's their problem. But if they really want to know about it, there are all kinds of videos from earlier this year where we went through all of those discussions. And we don't need to waste our time and our viewers' time talking about it anymore. You can go back and look at those old videos. What we want to talk about are the things that matter to the prices and the markets for gold and silver and other metals. I have a list of 12 topics, and I mentioned it to Kitco after the video. I said, you know, interest rate policies, the dollar, inflation, stock markets, you know, competing asset markets, overall economic activity, fiscal and monetary policies, the fundamentals of gold, what central banks are doing, and the fact, for example, that central banks have pulled back on the amount of gold they're buying now relative to where they were earlier in the year. I mean, these are the things that are important. Energy markets, new energy vehicles, the potential effects on metals. How fast will electric vehicles take market share? What kind of market share will they take? Where are they going to get the capital to build all those motors, let alone the batteries, et cetera, et cetera? There are all kinds of really interesting things and important things to talk about. And that's what I want to do. So today, I'm going to run through some of those things. I'm going to try to go fast because who likes long videos? Interest rates. Interest rates are increasing. You can see that little increase down at the bottom of this chart. And that increase is a negative for precious metals on a short-term basis because some people trade precious metals based on valuation models. And when nominal interest rates rise, those valuation models say, oh, other assets, stocks, corporate bonds, commodities have to decline in order to be competitive for the higher yields. Now we've gone from 1% to 1.58% yesterday for 10-year bonds. So it's a very small increase and a very low rate. But from a very short-term basis perspective, that increase has an effect on a short-term basis with prices of all assets, including gold and silver. But take a deep breath, think of yourself as a longer-term investor, the way we do, and they're saying, okay, yes, interest rates have risen. They're probably going to rise a little bit more. They're historically low levels. We haven't seen levels this year. This thing goes back to 1962, the chart on the left here. We haven't seen interest rates this low for at least a half a century, and probably actually going back throughout the whole thing. So the rise in interest rates might have a short-term negative effect, but they remain very low, which is positive for gold. And then on the right-hand chart, you can see the inflation-adjusted 10-year bond rates, which are negative, and negative by a wide margin. And if you look at expectations from the Fed, other central banks, and macroeconomists who actually are macroeconomists, they don't expect interest rates on a nominal basis to get high enough anytime soon, for years, to actually get rid of negative yields once you adjust for inflation. So interest rates on a longer term basis are very positive for gold and silver because they're going to stay low, and real inflation adjusted rates will stay negative. But you do have a short-term effect. The dollar's not collapsing. I have two charts here just to look at them. One is from 2006, and one of them is since 2019. So just very shorter term type of thing. And you can see the dollar actually has risen in recent weeks compared to where it was. I put the shorter term one in so you could see the full extent of the increase off of the base last year. And I put the longer one in here because you can see the longer term increase that we saw in the dollar, and the fact that, yes, the dollar's come off from the spike higher at the beginning of at the end of the recession last year to lower levels that are still much higher than what we saw back here. So the dollar actually is doing pretty well, and that's kind of a negative for gold. The good thing, or the saving grace for gold and silver, is that the correlation between dollar and gold prices is actually very low, and you have extensive periods of time, 62% of the time or something like that, maybe it's 68% of the time, when the gold price and silver prices are not falling as the dollar rises. So a rising dollar is not necessarily negative for gold. You have to go back and you say, why is the dollar rising? And when you look at why the dollar is rising these days in the longer run, the factors that are driving the dollar price higher, the dollar exchange rate higher, actually are also supportive of higher gold prices. That has to do with global uncertainties and the relative strength of the United States economy compared to Europe and other parts of the world. Inflation, concerning. It started to rise. We do think it's transitory. It's not worrisome compared to the inflation that we saw in the past, in the 70s and in the 50s, 40s and 50s. It's not bad. And then when you look at it and you disaggregate it and you look at the components of inflation, a lot of it looks transitory. So we say anticipate 22 data. Right now, you're looking at, this is CPI year over year. So we're measuring August inflation relative to August of 2020 when the world was shut down and people weren't buying stuff. And now it's August, September 2021, and people are buying things, they're replenishing things, they're moving forward. The US economy's moved from a recovery to an expansion. There's demand, but there are also supply chain and supply challenges, which are being inflationary. When you get to this time next year, you're going to be measuring inflation. You're going to be measuring the price change between August and September of 2021 and August and September of 2022. And you're going to see much lower inflation because this is the difficult time inflation-wise, and things will be a lot better by then. Competing assets, this is the killer. This is the stock market. And for all of those emails that we get all day long about how the stock market's about to crash and it's going to fall 50 or 80 or 90%, and you really should be buying overpriced coins from me now, the stock market's actually done very well. So then you get the Cassandras who say, well, okay, it's done so well that it's got to fall. It's just nonsense. The real economy also plugging away. We had a very big recession with the lockdown. We've had a very big spike back up. We've come back off, and now we're sort of looking like we're going to keep growing. And if you look at the US real GDP in dollar terms, as opposed to percentage change on a continuously variable year-over-year basis, you can see that, yeah, every time we have a recession, GDP goes down. That's sort of the definition of a recession. And, you know, this one here was kind of severe. This one was very short. And now we're actually at a point where we've gone beyond recovery to where actual GDP is above where it was in the fourth quarter of 2019. So the economy is actually pulling out. Now, there are problems that remain on the horizon, and we wouldn't be surprised to see another significant recession 2023, 2025. It's hard to predict when a recession will occur. It's easy to say there will be other recessions. There's 100% certainty there will be recessions. The question is when, what will trigger them, how long will they last, and how deep will they be? There are other questions too, like, you know, can the governments handle them? And I think they can. But we do think that 2021, the last 4 months of this year, 2022, we'll see economic activity, not only in the United States, but on the world, move forward in a recovery phase in some countries and an expansion phase in other countries. But we are looking down the horizon and saying there are clouds on the horizon, distant clouds, but they'll be on top of us all too soon. This is fiscal policy. Here's one of those clouds. I mean, you can see we ran deficits all this time. These are the monthly data. So when taxes are due, you'll see spikes up, and it's gotten really big and nasty. It needs to be fixed. There will be, I mean, this part of the spike had to do with the lockdown. That was transitory, but we still will be having deficits in excess of $1 trillion, well in excess of $1 trillion. That needs to be dealt with. And quite frankly, the country doesn't have the political will, either with the leadership in Congress and in the administration, or with the voters. We just don't have the political will to do what needs to be done to get the deficits back down to here, or maybe even turn them into surpluses, which, despite what some fairy tale writers say, do exist. We have had surpluses. We did have surpluses for 4 years under Clinton. Prior to that, the last surplus was LBJ's last budget in the late 1960s. Truman ran surpluses during the Korean War. It can be done, but the political will's not there. Again, looking at it slightly differently, percentage of GDP that is the surplus or deficit. And you can see a couple surpluses here, despite what some people say. This was the late 1940s. We had a very severe recession, post-war demobilization of the country. And then this is where we are today. Things are bad, not as bad as they were 60 years ago, but bad. And they need to be dealt with by ethical and intelligent politicians. So buy gold. And then this is monetary policy. We have seen a tremendous amount of monetary accommodation, bond buying by the Fed and other central banks around the world. In Europe, there has been some tapering, and now the ECB is saying they may reverse that because of the volatility in interest rates that has come with the tapering. The United States, the Fed has said that it plans to start tapering probably in this quarter, the last quarter of 2021. We'll see what happens. The last time they tried to taper, they had to reverse because there were some issues in the availability of dollars to pay debt, not by the US, but by corporations and others who needed dollars to pay the interest on their debt. So monetary policy is there, and it's very important to understand the Fed has plenty of bullets. I said a few months ago that the Fed has more ammunition than we left in Afghanistan, and that's actually true. They have the capacity to do what they need to do to keep us out of a depression. Real growth comes from fiscal policy, not monetary policy. So market outlook, pretty much the same as it has been. The prices of gold and silver have been kind of weak earlier this week. They sprung up this week, this morning, based on stronger economic employment data. We think that, our view has been that there's a potential for a spike down, possibly this week or next week. The markets are vulnerable, but from a longer term perspective, we don't expect to see what we saw in 2019 and 2020, which was prices spiking, peaking in August and then falling through the rest of the year. That happened in 2019 and 2020. There are concerns. We have concerns that it could happen again, but our gut feeling or our reasoned analysis based on economics and the fundamentals that we see in the gold and silver market are that the prices actually may move sideways more than declining over the next 3 or 4 months. I wanted to talk a little bit about silver. I know I said that it's a distraction to be distracted by these people who are distractions, but it is. But it's worth saying. This is COMEX on the left-hand side, trading volume, silver trading volume of the contracts, daily trading volume, and on the right-hand side, COMEX open interest. And you can see there was a spike earlier in the year, especially in trading volume. It also was reflected in somewhat higher open interest, and it's dwindled away. It's just not there. So the guys who wanted to squeeze the market don't seem to be squeezing the market right now. We have lower trading volume, we have lower open interest. And that's important because back then they were saying silver, we can squeeze the silver market and the price will be $100 by April or higher. It didn't happen. So then they said, okay, we didn't mean to imply that when we said we would squeeze the silver market, we would squeeze the price. We were squeezing the market, not the price. And anybody who thought that when we said we thought the price of silver would go to $100, we meant that we thought the price of silver would go to $100. They misunderstood what we were saying. And now they're saying that silver will reach $50 by December. I have the quotes, great scene from Casablanca where Major Strasser, the Nazi, says to Rick Blaine, the Humphrey Bogart character, what do you think about the Third Reich in Paris? And your beloved Paris. And Rick says it wasn't very beloved when I left, you know, because this woman had dumped him. And so he goes, well, what do you think about the Third Reich in London? And he says, well, ask me when you get there. And he says, what about New York? And Rick says, there are certain neighborhoods in New York City that I would advise the Third Reich to avoid. There's a street just about 3 miles from where I am right now in Brooklyn, named Bogart, after his family. Ask me what I think about it when we get to $50. And I'll probably tell you, take some profits. I might say, keep your silver, but buy some puts. These are our short-term views. We came out with our Precious Metals Advisory Monthly yesterday, last night, and this chart is from that. We have 3-month ranges of prices for gold, silver, platinum, palladium, rhodium, and then we have 8 quarters on a rolling basis, 2 years on a rolling basis of quarterly price projections for those 5 metals. These are our silver short-term price projections. We think that the market is vulnerable. We've seen it over the last month or so. It could spike down even lower in another sell-off, the way we've seen 2 or 3 sell-offs really since the beginning of September. And that you could test $20 or $20.40 is one of the technical chart points. On the upside, we still think that the prices could rise. We had thought that the price could get back to $28, and yes, it could get back to $28. But on a probability basis, probably $25 represents a near-term peak for the next 3 months for silver. We do think that the price claws itself higher over the course of 2022. And then if we are right about the timing of the next recession and the next financial crisis and the next US election, probably 2023, 2024, see much stronger investment demand for precious metals and higher prices. CPM Group does real research. I started with that list of about 12 different topics. I touched on the ones that are most important for gold and silver. I mentioned just in passing gold fundamentals with the decline in the central bank gold purchases, but there's gold, silver, PGMs, copper, oil. These are the things we like to talk about. These are the things that we spend our lives working on. And we provide real research and real advice and real consulting services. You can go to our website and read about us. You can send us an email at info@cpmgroup.com and tell us what you're looking for, and we'll tell you if we can help you. Thank you. Have a good weekend. Be good to yourselves and be good to each other, and enjoy yourself. We'll talk next week.